Thank you very much for joining this breakout session on strategic asset allocation. I will give a quick overview of the topic and introduce the speakers, then we'll move straight to questions. It's a fairly straightforward panel session and will be running for about 60 minutes. When PRI was founded, fund managers who explicitly recognised that sustainability issues are fundamental to asset returns were outliers. If we wind forward to 2020, climate resilience, governance structures, supply chain issues, and resource efficiency are now commonly discussed as key themes when picking assets. It's widespread practice. Our reporting framework shows that in the data from all our signatories. However, there's a missing piece in the jigsaw. Where are the asset allocators? For asset owners, asset allocation plays such a fundamental role to determining long-term returns that ignoring these sustainability issues, where the impacts affect economies, businesses, and society over decades, just doesn't make sense. Over the last year, PRI has worked on this topic with a number of signatories, developing a set of 13 case studies and a discussion paper that provides a map of what might be possible and what is practical examples within signatories. These case studies provide a great insight into signatory practice, and I certainly would advise you to look at those. You can find them on our website. These panelists and their organizations have realized there is a connection between asset class valuation and ESG. They've clocked that ESG factors can affect asset class valuations at an asset level as well as at sector level. Over the next 60 minutes, we'll explore some of their approaches, some of the challenges they've found, and share some of their industry practice. Before we start, I wanted to introduce the panelists. The first panelist is Dave McGowan, Director of Strategic Asset Allocation at BCI. He's responsible for research and recommendations related to clients' asset allocation and investment strategies, and conducts asset liability studies and strategic asset allocation reviews for BCI's entire client base. BCI, for your interest, manages just over 170 billion in Canadian AUM, mainly from 30 public sector clients, pension plans, and insurance funds. Savings represents just over 3 million savers across British Columbia. Our second panelist is Bob Smith. Bob co-founded Sage in 1996 and is President and Chief Investment Officer. Sage's journey started in the early 2000s, and ESG has long been a core part of its business. It started with negative screening, but it's come a long way since then. Bob has a real depth of investment experience, working previously at Moody's, Merrill's, and the Saudi Arabian Monetary Authority. He's got more knowledge on ETFs, Sage's speciality, ESG, and allocation than probably anyone in the US, and we're very pleased to have him on the panel. Our next panelist is Christian Goldsmith. He's close to 3 decades in the industry, more than half of which has been running global multi-asset portfolios. He works at Morgan Stanley Investment Managers and part of their Global Balanced Risk Control team, or GBAR team. The team itself manages just over $20 billion in US AUM and has been incorporating ESG factors since 2016. They take quite an unusual approach, really focused around volatility and how that impacts on asset allocation. He'll touch on that as we're going along. And finally, we've got Andrea Whale. She spent 12 years at Wellington. Wellington probably needs no introduction to the audience here. It's got just over $1 trillion in assets under management and uses a fundamental bottom-up analysis, but with an eye to macro implications, including things surrounding physical and transition climate risk. Her own personal role is to help Wellington and its clients meet a rapidly changing plethora of issues and challenges, expectations around issues and regulatory developments, Modern Slavery Act, the Paris Climate Accord, and the EU taxonomy. So on the panel, we've got 4 highly qualified panelists with a great ability to discuss the topic, which is strategic asset allocation and ESG. Andrew, maybe I could turn to you first. I wonder if you could outline Wellington's approach in this area. And I know when we prepped for this call, you talked about the difference in client base and how they're thinking on integrating ESG into an asset allocation level. Can you hear me okay, Andrea? Dave, maybe just while we're sorting Andrew's technical out, I could just open them for you. I know when we discussed the.
No?
Andrew, can you hear me okay?
I'm going to try. I can. I think I have a bit of a delay.
That's all right. But maybe you could open up on Wellington's approach on ESG and asset allocation. And I know when we talked previously about the difference in clients' approaches and how those change across geographies.
Great. So thank you so much. I'm really looking forward to the conversation colleagues have to say. Hopefully you're able to hear me, and hopefully I'll be able to sort out any future WebEx or Wi-Fi issues. I guess what I would say, true to form at Wellington, is that there really is no single way of incorporating ESG factors into any client portfolio. Around the globe, we find that clients are coming to us with very informed views of how they think about the risks and return opportunities linked to ESG factors. And what we try to do is pair clients with investors who share a similar philosophy and process. I will say that client does seem to be the common denominator, although some are solely focused on physical or transition risks, while others incorporate environmental risks more broadly. There are some who believe investing alongside the UN SDGs will provide them with a better way to participate in structural growth. And in that circumstance, we're leaning into those companies, both debt and equity, that are most likely directly linked to promoting those factors. But if I completely overgeneralize and try to put regions into buckets, the U.S. is focused on materiality to returns over a relatively shorter time horizon, and a greater focus on measurable risks and impacts drives a greater focus on climate transition and climate mitigation, given it's so tangible. And in Europe and Australia, I would say there's a general consensus on the concepts of double materiality, and how you get the returns is just as important as what the returns are. So that leads to differences on the margin about how PMs need to incorporate a broader array of ESG risks into their frameworks. Great focus on human rights, fair workplace environments, and community relations factor differently and may lead to a narrower opportunity set. But I find that clients in Europe and Australia are willing to make those trade-offs and disproportionately favor certain sectors or types of manufacturers. And then in the US, it's more common to have a conversation about investing in any asset as long as you're compensated for the risk. So there are some assets that clients outside the US just will not own, regardless of risk and reward. And so that does shift to how we think about what asset classes clients will have exposure to.
Thanks, Andrea. That's a good kind of intro to global differences in how clients are approaching or thinking about this issue. Dave, kind of turning to you, we talked a bit about the lens process, within your organization. Maybe expand a bit on that and how you think about ESG issues in the context of that existing process.
Yeah, sure. So BCI is a multi-client investment manager. So we have, as you alluded to, 30 clients. Our group acts as somewhat like an external investment consultant would, but we do that for our clients, and we consult to them on their strategic asset allocation through ALMs. Typically, is how we approach that. So our ALM process, we start by looking at the fund's characteristics. What are their objectives, their risk tolerance levels, and what are we seeing in capital markets? What's BCI's capital market expectations? And then what we do is we recommend themes that we think will improve the likelihood of meeting their objectives or provide better outcomes. And then what we try to do is we test those themes through a bunch of different lenses. Some of the more traditional lenses like stochastic or scenario analysis, but climate change is one that we're looking at. Climate scenarios is a relatively new lens. And so, when we look at that lens, it allows us to then, look at the resiliency of the portfolio, as well as compare portfolios if we're looking at possibly making a change to see how those portfolios might perform under different warming scenarios. So, our clients generally have quite a strong ESG focus to them, and so this modeling that we've developed has really been well received. I think sometimes you go through this, and then the big question is it's new information. We have many different lenses we look at, and so sometimes it's difficult to know what to do with this information, particularly because it's new. But I think as time goes on, clients will sort of become more comfortable seeing this information, and it may affect decisions more in the future.
And Dave, how do you think clients, the kind of the range of reactions clients have come back to you with when you've said to them, look, we've started to think about climate change in this overall process. What's been the response?
Yeah, I think, well, the way we use it is generally it will either confirm or counter some of our existing themes. So it works as sort of a checking exercise to say we've recommended this theme and it also looks good under these climate scenarios. Now, it gets a bit more difficult if it's a counter to some of our themes, and then sort of decisions need to be made. I wouldn't say clients are optimizing their portfolio based on climate scenarios, but it's, I think at the minimum, it's developing risk awareness for them. And so certain decisions they're making may have implications under certain climate scenarios. And so now it may not affect decisions now, but at least they have the awareness of what risks they may be facing in the future. Thanks,
Dave. Christian, kind of turning to you, and it sounds as though the GBAR team at Morgan Stanley Investment Management have been thinking about these issues for a good couple of years now. Just maybe expand upon the approach and how you overlay climate change as an issue on an existing process.
Yes, Toby, of course, thanks. As you said in the intro, it's interesting to be part of an SAA discussion when we don't actually do SAA in the traditional framework sense. We're actually running multi-asset portfolios in a way that takes risk as a starting point, and effectively we are constructing our asset allocations in a way that's intended to deliver a certain level of risk over time, of course with attractive returns for the risk that we take. But the thoughts that we've been implementing recently have actually been sort of going down a level from there. So looking at the building blocks, specifically if you think about the case study we submitted, the core equity exposures in our portfolios, and looking at what we've been doing over the last few years, which has been tilting those exposures towards higher scoring companies from an ES and G perspective. So important to say that we do look across the spectrum of ES and G. What we've effectively been doing is taking control of our own exposures to, for example, US equity market, Europe, Japan, and constructing baskets of securities as if we were an index manager, you could say, that will replicate those indices, but enable us to add additional factors in when we're actually constructing the baskets. And these include, for example, environmental, social, and governance scores, scores which reflect the underlying company's exposure, good or bad, to the low carbon transition. And then if you build from the bottom up, what we end up with are exposures to these markets where we can have basically the same sector exposures, but within those sectors, higher quality exposure from an ESG perspective. And then where we've taken that a little bit further over the past 6 months is to say that actually we can align those equity allocations, our core equity exposures, with the 1.5 degree scenario. In other words, we can work towards a net zero scenario by 2050 by effectively over time, quarter by quarter when we rebalance, reducing the carbon emissions of each of those baskets, subject to, of course, tracking errors and other constraints. But we've effectively set ourselves on a 1.5 degree pathway, let's say, based on sort of scientific pathways supported by the IPCC. So in this way, we kind of get a broad global equity exposure within our multi-asset portfolio that hopefully has a better ESG profile overall, but also reflects that additional concern about climate change being the factor that's most affected by, let's say, regulatory considerations.
And Christian, just kind of following up on that, what does that overlay, what implications does that has for the overall shape of the portfolio, the other metrics that you might use in a standard measurement of a multi-asset pot?
Well, that's interesting because actually if you think the starting point is to say that we'd like a US equity exposure that looks something like the S&P 500, but with these enhancements, that enables you to really still make decisions according to your regional equity views and implement those consistently. But what it means, of course, is that from a risk monitoring perspective, then our independent risk oversight teams are giving us extra scenario analyses to let us understand what the profile of the portfolio looks like. I think the final thing to say, to sort of preempt a potential question, is at this stage, we're doing this based on our core equity component. And we'll be looking to sort of replicate this in other asset classes, but this is something that we've just been implementing over the past year, which we think is quite an interesting concept.
Thanks, Christian. Bob, kind of moving to you, and I know you've got a slightly different organizational experience in perspective, rather, in terms of your use of ETFs as a mechanism for asset allocation. I wonder if you could just expand upon that approach and some of the history or the background knowledge, in a sense, you built up in that area. You're on mute, Bob, if you just take...
For being here. Sage is a smaller manager by comparison to some of my co-panelists here, but we are no less, involved and focused upon ESG and sustainable investing. We've been doing it since the early 2000s. Primarily on the fixed income side of our business, where we do a fair amount of institutional investing for a variety of different types of institutional clients. And we began our journey into the responsible investing community largely, as Toby had suggested, through negative screening, which I think a lot of people would find that that's where they started compared to where they are today. Over the course of the last several years, we have become more and more evolved and much more ESG integrated. We haven't totally left all of our negative screening, and indeed we combine them. These are not mutually exclusive practices. In fact, they can be somewhat complementary at times. But since 1998, we have always been recognized around the country as an active ETF strategist. Yes, we're a fixed income manager on one side of our business, but we're a very early strategist in the ETF space and have built a relatively good practice both on the institutional and the private client side. And we're on several different platforms. Over the course of the last 3+5 years, we introduced into our ETF strategies ESG optimization. And that wasn't because we didn't want to do that. Prior to that, we had to wait for the market to come to us. As you know, the ESG space and the ETF space have really grown rather tremendously over the course of the last 5-6 years. Navigating that is a very tricky and difficult process because many of the products that are available for investors to pick from generally have the same title. But do they have the same shade of ESG integration? Do they negatively screen greatly or little? And if so, how so? And so these are the things that, as a strategist, getting inside the box, that's our practice. And that's really what we try to get at in terms of creating an ESG optimized portfolio, whether we're talking about fixed income, whether we're talking about equities, domestic, international, large, small, and so forth. And so we've been a very active strategic asset allocator over the last 5+ years, primarily using ETFs as our modality. But again, we're a macro top-down manager for everything that we do. And those are constants, whether we're talking fixed income, whether we're talking about equities and so forth. Those are big drivers for us, but right underneath that is the ESG integration part, particularly for those ESG optimized portfolios. We also find that on an increasing basis, the asset allocation decision is being left to us for regulated assets. A big driver right now, and it's going to continue to be, is in the insurance space. And we're finding that a lot of our insurance clients are increasingly being asked by regulators, what is their exposure to climate risk? How is it found within their portfolios? And what are they doing to manage that risk in their operations? And so here again, whether it's we're on the equity or the fixed income side or even the cash management side, which is another area that we provide some ESG focus for people and have a specialty in, I think these are the areas that we see future growth. that as more and more regulated industries are being asked to be more concerned and more involved with ESG issues, managers such as ourselves, strategic asset allocators that can work with them with an ESG focused lens, are going to be increasingly important to these organizations. And so that's our focus as a business. And I'll leave it there because I know we want to get to the other questions.
Thanks, Bob. And I should have mentioned we've got one question in the chat function. Feel free to add them as we're going along. I'll try to come to them at the end of the session, and we can go through as many of those as possible. I think most of you just in that entry, a kind of overview have highlighted climate as really the key issue, and I suppose that's no surprise. It certainly was a really key theme within the case studies that various signatories provided. But I do kind of want to, and maybe it's not a surprise, it's scientific basis, there's data around it, and you're able to model and kind of build scenarios. Dave, I know we talked around the lack of data elsewhere as a barrier to thinking about other issues and other topics to incorporate in SAA. Maybe just expand on your thoughts around climate is the only factor you can do, and this is why.
Yeah. So, I mean, we're currently looking at other factors, but right now what we're bringing to clients is climate change. I think one of the main reasons is the other ESG factors have been more idiosyncratic and sort of managed more from like a security selection standpoint. Whereas what we're looking for SAA is more systematic risks that will go across geographies, really affect markets. And I think the key is that they cannot be diversified away. So we're trying to look at those types of risks. Now, other ones that we're looking to add into this framework that we're examining right now are water risk, cyber risk, and income inequality, as well as further refining climate change. But we think climate change is a good starting point. At least we're looking at these because the time horizon as well. Obviously, climate change will affect the entire market, so it's something you cannot necessarily diversify away. So it is sort of a beta risk, as we would say. But also the time frame, the time horizon, the long-term time horizon of climate change matches well with the long-term nature that we're looking at when setting our strategic asset allocation.
Thanks, Dave. Andrew, we had a similar discussion when we were prepping for this around climate providing really key pricing signals and being the kind of the starting point in a sense of this process. I just wonder whether you could expand on that, whether there's other issues where stakeholder concerns, whether environmental, social, and employee kind of overlap with shareholder value or valuation on asset classes as a grouping.
Yeah, I'm happy to talk about this. This is something where Wellington has really dug deep, particularly on the physical climate risk side. So we launched a partnership in 2018 with Woodwell Climate Research Center, because what we realized is that actually the scientific models around temperature and climate change are rock solid. I mean, we can go back hundreds of years, and those models that existed a long time ago have been incredibly predictive about the path that we're on. There's really a high degree of certainty. I think what has been missing is that translation of the science to basis points. And so the partnership has really been focused on modeling out 7 very specific climate risks and then translating that into what are the actual risks that investors are taking when they're investing in a company that is sourcing product from areas of the world where we know that drought and wildfire are on the horizon and highly predictive. So it's an easy one to go to in that it is so measurable and so tangible. I would take climate mitigation or adaptation as like the next 1 degree of separation, where you're really then trying to think about, well, what are then the reactive behaviors of people, companies, governments, markets to those first degree changes in our climate. I think part and parcel with that is, I think the social developments actually tell you a lot about the governance of a company. So what we found in particular in a global credit product that we manage, that actually if you focus on how good a company is on the E&S, it's entirely predictive of how good their governance is, right? If you don't, it's almost like you don't even have to look at governance anymore. You really focus on how do they treat their employees? How do they treat their stakeholders? How are they treating their community? How are they thinking about being responsible stewards of the environment? And you know a lot about that company. So I think we actually think all risks are informative, but I would say the ones that are easiest to talk to clients about and put numbers behind and really, pin down and say, hey, look at these 2 muni bonds. One is in Texas in a high flood risk area that they're going to have hurricanes. This other muni bond is in Michigan in the middle of nowhere. There's no risk of hurricane or flood or drought or wildfire. They're the same credit rating, same duration, and they're priced exactly the same. Which one would you rather own? And I think it's pretty easy to say, well, you're going to own the muni bond in Michigan that has incredibly low environmental or climate risk, because you know that 30 years from now, you're more likely to get paid back than on that bond that's sitting in Houston. And so those are how we're trying to take the risks and directly apply it. But then we are trying to expand our universe to think beyond that, to help us understand which companies are well positioned to be around for the long haul. We're doing the same thing at the country level and really trying to look at what is happening from a climate perspective, but also in terms of what is the rule of law, what is the strength of country infrastructure in terms of supporting its people, supporting the economic development of its people, and how does that help us think about where do we want to be allocated? If you have a choice between India and China, how do those insights inform your asset allocation in that regard? So I do think there is something beyond climate, but I will say climate's so nice because it's so easy to model.
Thanks, Andrea. Christian, I know we talked about some of the sector-specific aspects, the GDPR and its impact on technology sector. Does your modelling within the GBAR team start to incorporate some of those broader factors as well as climate, which has clearly been a factor for some time now?
Yeah, I think it's important to say that across the total portfolio, we do want to make sure we are paying sufficient attention to E, S, and G, as I said before. And I think that we can do that in a number of ways. So, for example, we have impact investments, we'll have a degree of negative screening, and we'll have the best in breed sort of approach that I described previously in terms of wanting to hold the best quality companies for all of those factors. You mentioned GDPR. That's an example of something where we just found that it was difficult to build it into a sort of longer term model, but it was certainly something that when that was announced and came into play, and the impact that can have on global companies, the global data protection regulation, being subject to fines, potentially if you're not treating customer data properly, significant fines for any company globally that's doing business in Europe. That was an example of how that actually affected some of our more tactical positioning. Building it into longer term models is a little bit more tricky. So hence you do come back in terms of, from our perspective, what is the most urgent challenge, we would say, is climate change. The challenge which has most regulation, either already in place or coming into place soon, that's going to be potentially a threat to asset classes and companies. And therefore, that's one that we are giving an extra tilt to within our ESG-wide portfolios.
Thanks, Christian. But Bob, turning to you, I know when we discussed this, just a single focus on climate change, you went a bit red and you used the words myopic and lazy. I just could maybe expand upon that and follow it up.
Well, look, I mean, myopic, perhaps, lazy, I might rethink that statement, but I think it's the easiest to measure. And I think what Andrea had mentioned was, look, there's lots of data to look at, and we can definitely pick through it and look at the things that we think are most relevant and so forth. But I think you have to think of climate change more. It's a very popular concern, there is no doubt. and it's very important, but we look upon it as a long-term illness that we have to set upon immediately, but you're not going to cure it overnight. It has to be worked out over a very, very long period of time. And so, yes, it's important. Yes, we want to try and mitigate its effects, but you're not going to affect the trajectory in the short to near term, or even the intermediate term, to a very significant effect on a broad base, on a one-by-one basis, perhaps in some cases. And so for us, looking at today's world, social issues, more than anything else, have erupted in terms of where people's greatest concerns are. Customer and worker safety are paramount right now. Child education and all the things that we've realized now in terms of an economic system that really wasn't, quite prepared for some of the things that erupted as a result of the pandemic. And so all of these have become massive investment concerns, either with companies that have really jumped on it or for organizations that were not well prepared for it. And so I think we have to be facile and dynamic in understanding that while climate change looms in the background and is very important day by day by day, there are more immediate concerns that have direct impact. And for us, you are not ever going to become a sustainable organization naturally or by accident. It happens through intention and good governance. And you cannot have good E or S without great G. That is just the way we look at it. And so for us, governance is the driver. And we look at 5 C's when we look at governance. First thing for us is the composition of the management. How are they structured? How do they operate? What is their longevity? How diversified are they? How do they run themselves as a meritocracy and so forth? All of those things are extremely important. We look at things like competency. Do they know what they're doing? Do they have really smart people? Do they have leaders in terms of the areas that they operate? Third one, compensation. How are they compensated? Are they compensated with the ESG goals and objectives in mind that I have in mind that I think this organization should be focused on? If not, why not? Fourth C, consistency. How consistent are they in their policy adoption and their application and execution over time? Because what you are today may be different than what you are tomorrow, and that's what I'm looking for as an investor in terms of future capital value. And then lastly, the biggest C of all, clarity. Another word for that, transparency. And those are the 5 C's of governance as far as we're concerned when it comes to ESG. In the absence of all of those not really being strong or really working very well, you'll never get to have great E or S within your portfolio. So for us, we are always going to be looking at governance first and foremost. It is the spring where all good E and S comes from. And obviously, some industries are going to be inherently, have higher risk when it comes to environment and social issues. Some are going to have less. What we want to be able to do is to see how managements adjust and calibrate and what their focus and attention is. Does it match up well? But let's face it, climate issues are grabbing a lot of headlines. But what are the ones that are going to affect your portfolio tomorrow? I bring you back to little ditties. Enron. Remember that one? That wasn't climate. VW. That wasn't climate. How about Equifax? That wasn't climate. How about Samsung? Faulty telephones that kind of created fires. How about Tesla? These are all management flaws that went off the rails and created immediate losses or hits to capital value until they got corrected. So we have to be focused on the G a lot, because you're never going to get there from a sustainable standpoint by accident. It has to be driven there. And so that's our point of view.
Thanks, Bob. Dave, turning to you, and I know, and kind of slightly following on from that kind of question or answer from Bob, just in terms of the concepts of data and how that's utilized. I remember we talked about idiosyncratic and systemic data or approaches, and Bob's highlighted some quite specific examples on corporates. How do you broaden that to an asset class level? Clearly key from this approach.
Yeah, so I mean, our group, we don't look at security selection. We're focused on beta, and we're really focused on the asset class level. So some of the examples Bob gave we would see those as obviously risks, but those are security selection risks that could be diversified away, like an Enron, for example. And we have great portfolio managers here who are looking at those idiosyncratic ESG risks. But the type of risks that we need are, as you say, systematic risks. And so, the way we approach that is we use a third-party resource. We use Mercer's climate change research package. And then what we do is we work with them to customize it to BCI's programs. So just to, acknowledge it, the unique geographic concentrations that we might have, or sector exposures, because we have a lot of private markets, maybe more concentrated than something like a broad equity portfolio. So then we use this to look at three different scenarios: a 2-degree, 3-degree, and 4-degree warming scenario. And each of those have different implications on different asset classes. So what allows us to do is look at each asset class and sort of determine, what are directionally, at least, what are winners and losers of these asset classes in these different climate scenarios. And then you can take that a step further and start to compare portfolios when we're working on some of the asset liability reviews. So it's important to have these systematic risks that are going to affect the economy more broadly. And it's almost like, when we determine our capital market assumptions, it's really no different than that. It's sort of just looking at saying, this is our best case of estimate of what we think is going to happen in the world, but we know we're going to be wrong. I think it was Andrea said that the climate data is is great, and so the climate data is great. I agree. I think we can project these things, but projecting asset returns is always going to be wrong. I think we have to acknowledge that we're going to be wrong, and then when you're looking at that variability, where are the risks if you're wrong? And so this climate lens allows us to have that additional look at that.
Thanks, David. And Andrea, kind of jumping to you, I know we kind of talked around country allocations, building that approach on asset classes at a kind of country by country level. Really, it's not really asset classes in a way, but it builds up from that single company approach. Just maybe touch on that and how climate in particular feeds through to allocations on a national basis.
Yeah, so we have been working to actually study country by country what we think are kind of I'll call it the 5, 10, and 30-year implications of climate change and how that will impact those countries based on plans they have put in place already and plans that they could contemplate putting in place, so that we can have a forecast for how we think about what are the potential implications on the local populace and on local physical assets in each country. And we use that information really to help inform how we think about the pricing of risk for a given country and whether or not it's being adequately incorporated into the debt and the equity issuances of countries that are in those places. I think the other thing I would say, and this is more of an asset class distinction, and I'll layer that on with a time horizon distinction. If you're going to buy a bond and it's cheap, but you actually have complete confidence that bond is going to be paid out, and it's in an asset that has climate risk, but the company is diversified, or you have very high degree of certainty that the likelihood of getting paid in full at the end of the term of the bond, you're much more willing, I think, to take climate risk in that situation than you are in an equity security where it may be trading cheap because people are concerned about that climate risk, but there's no forcing mechanism to make it go to par. And so I think part of what you also need to think about is, where are you willing to take risk in your portfolio, and how do you want to express that? We were speaking with actually a colleague of mine was speaking with a very large Texas pension plan in the heart of Texas oil land. And they are thinking hard about whether or not they should continue allocating to private oil and gas. This has been a long held position in their portfolio. They're investing in their own state's economy. but they have serious concerns. And so I think it's really the duration of that investment that's causing into question whether or not they're going to continue allocating capital there. And so much of these risks are based on how long you have to wait to get paid out on taking that risk, and what is your certainty that you can reach that recovery. And so, you will have individuals who will absolutely say, yeah, India has lots of climate risk. Pollution is terrible. They're 100% dependent on coal. They're going to have to undergo a massive transition in their energy infrastructure in order to both deal with their pollution issues, but also deal with carbon. If your time horizon is 12 months, you're probably not that worried about it. If your time horizon is 10 years, then I actually think you're, definitely exposed to incremental risk in that situation. And so those are the kinds of questions that we're always trying to get clients to help answer, so that we can think about, how should they be thinking about pricing that risk?
Christian, I turning to you, and asset allocation is such a fundamental driver of returns for multi-asset portfolios. And these decisions have to be right, otherwise you'll be kind of challenged in the years to come as those implications become clear in terms of returns. How do you make sure, as much as possible, it works? That taking these great ideas that we've touched on as a panel, can be explained to clients, can actually add to returns?
Well, I think from our perspective, the first thing is if you think our starting point for building a multi-asset portfolio is risk, probably more explicitly than in many multi-asset approaches, then the first thing that we can do is to see whether the incorporation of some of these factors has an impact on the risk profiles of our portfolios, but also understand what the overall risk profiles are. And one of the considerations, for example, is, okay, let's go back to the climate change scenario. So I think we discussed that there's perhaps more data available on that particular factor than on others. But certainly we intend to build out, a range of different risk metrics that will help us understand different ESG factors and how they impact the overall portfolio. But if we go back to the transition risk, so what we run on a daily basis on our portfolios, or what our independent risk oversight team runs, is scenario analyses which are enabling us to understand what might happen to that portfolio's value, for example, in terms of the potential drawdown if we were to have certain transition-related risks materialize. And most of those are related to policy change related to carbon pricing. But for example, if you were to have a phased increase in global carbon pricing, or if you were to have a shorter-term shock, perhaps in response governments to extreme weather events, or even if you had a combination of a change in carbon price and policy at the same time as governments were trying to address other factors such as economic inequality. So we're able to run these analyses. This is using largely third-party vendors' data, and we're able to run these analyses tailored to our portfolios just to understand what the impact could be. So that's one consideration, but we need to then take that onto other factors. So next in line is looking at the physical risk, and we're looking at how we can address that in the portfolio. That's sort of the financial risk to the portfolio. And of course, if we start with something like an objective to decarbonize our core equity exposures within our multi-asset portfolios in line with a 1.5 degree scenario, then of course we have a number of metrics which show whether we're achieving that. For example, if you compare our equity allocations to, let's say, the MSCI ACWI as a representation of global equities, we have somewhere between 10 and 40%, depending on which region you're looking at, within that lower carbon intensity than that benchmark would have. So we can say that we're meeting that, what you would call a real world outcome, perhaps.
Andrew, that communication back to the client process, clearly the risk reports on a monthly basis are a key aspect to that, about explaining risk both internally and externally within your organization. Have you started to feature some of these factors into those reports, and how are you thinking about that?
Yeah, I would say that's been a huge focus for us. So, I think all of us as investors are very familiar with kind of the BERA risk frameworks and risk factor modeling. And all of our portfolio managers get, an 8-page report that details every different slice of their portfolio based on different factors. And what we've been in the process of building out is really first starting at a security selection basis, giving portfolio managers baseline information on climate risk. So should you be engaging with them or not? And what are the types of risks that you think they're exposed on? So just that baseline level of information. But at the same time, we've also started to do ESG portfolio reviews. We started this actually a few years ago, where we'll sit down with portfolio managers, review their total portfolios, and give them feedback on where the greatest risks lie within their portfolios. I expect in the next year or two that will continue to evolve. And instead of an 8-pager that's focused, primarily on risk factors that you would find in a common BERA risk factor report, you're going to see a page or two that's focusing on what are the environmental risks, what are the social risks, and what are the governance risks that are most predominant, and what scenarios are going to really stress your risk. I think if you asked anybody a year ago, what's going to be the big risk that you're going to be contending with in 2020, I don't think people would have said COVID, racial disparities, and, health and education of children, as Bob Smith said. So I think that there are always going to be new risks that you haven't built out your frameworks for. But I do think as we bring in these ideas of biodiversity, that is the cause, like the primary cause of COVID, right? So we understand that's a risk we need to start tackling and thinking about and understanding how we frame it in the context of the portfolios we're managing for clients. Because we've heard it from the scientific experts, there will be more pandemics in the future. And so now we need to understand, well, how then do we think about that risk?
Thanks, Andrea. And that picks up nicely on one of the questions in the chat function. I was going to pose that to you, Dave, actually, in that you outlined a couple of different risks there, water risk, cyber risk as being factors you started to work with within your own process, and that kind of incorporation of biodiversity as a concept. I don't know whether that started to creep onto your agenda, but also how you explain to these clients or to try and put across any implications of incorporating these types of issues on sector concentration, on other implications of the overall plot.
Yeah, I think any opportunity we have to shake our base case is great, and anything, because we know climate change is obviously one we've been using, and we hope to improve on, but there's others, as we talked about, and I think it's important to look at as many lenses as you can, and just to help that decision making for clients and develop risk awareness as well. It'll be difficult to predict what things we'll be facing in 2021 or 2022, for example. Andrea gave some good examples. Who would have thought would be most of us at home anyway right now. So these things are tough to predict, but anything you can, you think you have a line of sight on, and if you can model it, basically, we should be looking at it is how I see it.
Bob, I know kind of benchmarks is an industry mantra, and it really drives behaviour in terms of both single asset allocation, but also kind of asset class allocation as well. I just wonder whether you'd kind of touch on that in the context of taking on board some of these factors, and we've seen and using it for a measure of relative performance. Certainly, the last 6 months seen some good outperformance, but what should we read into that?
Well, there's a number of issues that you can speak to in that regard. I think that, getting back to what Andrea said and others have said, I think the idea of climate and climate risk pricing in terms of, capital value impact in the short, intermediate, and long run is very important. Whether or not you have an established methodology or metric for that, I think we're still in early days. We're releasing today our second paper on pricing climate risk as it relates to municipal securities. There are two issues there. One is not only the ability to absorb the risks, but also what have you done to prepare for future risks? So there's a balance of two equations there that we infuse into our system. We utilize a proprietary ranking system or measurement system called our Leaf Score, and we use this both for stocks, bonds, anything that we invest in. We evaluate all of our companies, and then what we do with our Leaf Score, score them from 1 through 5, 5 being the highest, 1 the lowest, in the way that we can normalize across industries, and this took us many, many months to kind of work those balances out. But it allows us also to understand with our portfolio managers, this is a relatively strong or very strong company. These are the ones that are weak. These are the issues behind them. We back that up also with independent research, our own views of companies from an ESG perspective. So this is why this Leaf Score is the way it is, and these are the things that we think are of great concern, and go on from there. So having a point of view, not buying somebody else's point of view, slapping it in your portfolio and say, that's what mine is. That, in our opinion, is way short of the mark of what should be done. The third thing I think that's really problematic within our industry still, but I think we're going to get over the hump, is that we don't report to clients on what is the inherent ESG value in your portfolio in a way that you understand it. And so we, on a CUSIP by CUSIP, ticker by ticker basis, will give you the Leaf Score, meaning our clients, so that they can understand just as well as they understand what their credit rating is, what their allocation is to various different companies within sectors. What is your relative strength in terms of your overall ESG-ness in the portfolio? Is it trending up or trending down? Is it concentrated or is it fairly well diversified and spread throughout your portfolio? And once those things become more present in the dialogue with clients in terms of what's at work in my portfolio, and is it correlated with the returns that I'm seeing in my portfolio, now you're having a more effective dialogue. You get greater buy-in, and there is a greater understanding by the end buyer or the asset owner. I see what you're saying, and I see the value of it. And still, as an industry, I think we're way apart from the mark in terms of where we have to be from a reporting standpoint to get more buy-in. And so what we've tried to do with our clients is to provide that translation in an effective way that whether you're a large or small, institutional or private client, you're going to understand the ESG values in the portfolio and over time come to appreciate them. And so those are things that I feel that mitigate against progress in terms of getting greater awareness on the part of clients. Everybody reads in the newspapers what are the popular topics, and I guess climate's a big issue. But if most of your portfolio is made up of service-based organizations, and there isn't a high degree of inherent environmental issues with those organizations, then maybe you should reorient kind of your discussion and tell them, look, these service-based companies, they have ESG issues, but in different ways. It's not a climate issue. And so those are things that we need to be more effective about, I believe, as an industry in terms of getting people to understand how to infuse ESG analysis into the fundamental financial analysis that we do. As we do that, it becomes more normalized. It becomes normal. It becomes part of core fundamental analysis. No longer will it be siloed as something separate and distinct. So we're in that transition phase right now.
Thanks, Bob. I think I've got one last question to everyone on the panel, really, and we've got a couple of minutes left. So just in terms of obviously a lot in the audience who may just started to think about ESG and RI and how that overlaps with asset allocation and strategic asset allocation. Maybe if you were to leave the audience with one piece of advice to start to think about as they return to their kind of day jobs, as it were, what would that be? And Andrew, maybe I can start with you.
Sure. So I guess, so I'm going to say two things. You said one, but first and foremost, I think really think about what your time horizon is and what your ability to, really extend your time horizon for evaluating your investments. And the second, and I think related, is what is your tolerance for idiosyncratic risk? Because I think, like Bob highlighted, a number of companies where those were all idiosyncratic events that had traumatic effect on security pricing. And so tolerance for idiosyncratic risk and time horizon, I think, are the two keys to thinking about ESG factors overall and how you want to incorporate them into your asset allocation.
Thanks. Christian, what would be your one takeaway?
Okay, I think I'd probably be quite straightforward and say, start now.
There we go.
Lay out a path that you intend to follow, but don't expect necessarily to stay on that path the entire time. As data changes, as evidence evolves, be flexible in terms of how you intend to actually achieve your ESG goals within your SAA.
Thanks very much. That's brilliant. Dave?
Yeah, I think these different ESG factors will ultimately affect the economy in one way or another. I think we need to sort of acknowledge that, and I think the other thing to acknowledge is the complexity of modeling, and acknowledge that we're going to be wrong. But given that, I think it's still important to try to get a handle on things and how they might play out over time, and factor them into portfolio construction wherever you can. I agree with Christian. Start now, start looking at them now, and as things evolve and these things improve, you'll have a head start on others.
Thanks, Dave. And turning to you, Bob.
Sure. I think the first and foremost thing is to thine own self be true. What is your policy? What are your goals, your objectives? What are you trying to achieve? Identify them, know them, frame them out so that you have a consistent policy that you would apply across all asset classes. How that is executed across asset classes has to have a degree of flexibility, because ESG-ness can't be found in certain areas very easily or in great abundance in terms of what do I have to work with as an asset provider or as an investment manager and so forth. So have an overarching view about this is what we feel about ESG and sustainable investing, how it relates to us, and these are our goals and objectives, whether we're talking about cash, stocks, bonds, real estate, alternatives, and so forth, that they will be applied in different force, but with the same consistency in terms of goal and objective.
Thanks, Rob. I think all that's left for me to do is thank our panelists this afternoon, Andrea Whale, Christian Goldsmith, David McGowan, and Robert Smith. They're clearly all prepped for this session really thoroughly and gave us a really good overview of a range of different issues and how they're applicable into asset allocation as a process. So thank you very much for listening. Please accept my thanks for the panelists. And if you would like to return to the remainder of the conference, I think you return through the live stream function. Thank you very much, and have a good rest of your day.